In 1980, Deng Xiaoping granted economic privileges to Shenzhen, a small town near Hong Kong. Over the course of 40 years, Shenzhen transformed into a global economic powerhouse, surpassing Hong Kong's GDP. China's widespread economic reforms led to the development of several influential cities, contributing to global poverty reduction. However, challenges have emerged, including concerns about perpetual growth, prioritizing short-term gains over long-term stability, and a looming debt crisis despite low national borrowing. The situation raises questions about the unpredicted challenges facing China's economic model. Why do impressive growth rates in any regular economy pose a threat to China? Why does the affordability of goods raise concerns about the nation's economic well-being? How does a country with relatively low national borrowing face a looming debt crisis? Most importantly, is this situation distinct from the numerous occasions on which economists predicted the inevitable decline of the world's second-largest economy? Before analyzing China's current economic challenges, it's important to acknowledge that the country is a source of international tensions. These tensions range from potential conflicts with technologically significant nations to human rights concerns and the notable shift it has caused in the global balance of power over the past century, where the USA has been the leading economic power. With these complexities and other factors in mind, there's a noticeable eagerness among people to hear about a possible collapse in a country that now holds the position of the world's second-largest economy. However, the desire for a particular outcome doesn't necessarily match reality. China has largely reopened after implementing the world's longest and most stringent lockdowns in response to the global pandemic. The government took extreme measures to manage questionable case numbers, dictating when individuals could leave their homes, work, shop, travel, or engage in economic activities. About a year ago, when these restrictions were lifted, there was optimism that economic activity would bounce back strongly as people resumed activities that were restricted during the extended lockdown period. While there was an uptick, it fell short of the intensity predicted by economists and the government. China shifted from nearly double-digit annual growth rates pre-pandemic to about 5% today. In simple terms, this means that the Chinese economy is producing 5% more net goods and services in a given year compared to 12 months prior. Some media outlets and certain economists have pointed to this slowdown as an indication of an impending crisis in China, but often without providing a comprehensive explanation. While 5% growth is low by Chinese standards, it remains an impressive figure, especially considering the downward trend in growth statistics over the past decade. Western economies typically aim for a growth rate of 2 to 3% annually, which is half of what China continues to achieve. The question then arises, why are growth figures that would be considered remarkable in the West seen as a crisis in China? The key factor at play here is expectations. Imagine an individual earning $50,000 a year who plans their budget with the expectation of a 10% annual salary increase. Based on this anticipation, they might make significant financial decisions, like taking on a larger mortgage or expanding their family. While comparing personal income to a country's GDP isn't a perfect analogy, it highlights the issue. GDP is a yearly measurement that resets, much like an individual's annual income. The problem arises when there's a gap between expected and actual growth rates, causing challenges for both individuals and the nation. Higher GDP and income directly contribute to national and individual wealth and debt levels over time. With a higher GDP or income, a country or an individual can pay off debt and accumulate assets more quickly. Metrics like debt to GDP in economics are comparable to debt to income in personal finance. The compounding nature of growth rates make these metrics significant. Over a decade, a 5% versus a 10% annual growth rate can nearly double the output. For example, an economy with a $1 trillion GDP would grow to $1.65 trillion with a 5% growth rate, but it would reach $2.71 trillion with a 10% growth rate. China, however, based its economic development on the assumption of much stronger and sustained growth than 5%. Investments by the government at various levels, including individuals, local entities, and corporations, were made with the expectation of the robust growth experienced between 1980 and 2010 continuing. Projects like ghost cities, entire urban centers developed but largely unoccupied, exemplify this optimistic planning. While some defended these projects, expecting a future population influx, the reality lies somewhere between full occupation and persistent vacancy. The real estate sector in China is facing problems due to overly optimistic expectations about future growth. This issue extends beyond real estate to other areas like infrastructure development, trade deals, and large international projects like the Belt and Road Initiative. These projects were undertaken with the belief that China would rapidly expand into untapped markets. While optimistic planning itself may not be a crisis, the rapid growth of debt in China is a concerning factor. Despite China's reputation for national and individual savings, the country is accumulating a significant amount of debt. The national debt to GDP ratio is about 77%, which has increased over the years but is still considered healthy. However, this ratio only considers the debt of the national government. Provincial debt is more alarming because provinces don't have the authority to print money and could potentially become insolvent. Tracking provincial debt is challenging due to different reporting methods and potential misreporting of economic statistics. Estimates suggest that provincial debt in China is over $23 trillion, equivalent to 150% of the country's total economic output, in addition to the national government's 77%. Municipal governments generate revenue by selling state-owned land to developers on long-term leases. However, they can only sell land if people are willing to buy property, and people are only willing to buy property if local governments invest in significant projects. If accurate, the combined provincial and national government debt would surpass 200% of the country's GDP, raising concerns even in resilient economies. Furthermore, a significant portion of government initiatives in China are funded not directly by the government, but through state-owned companies. These large enterprises, like the China Construction Bank, China National Petroleum Corporation, and the China State Construction Engineering Corporation, play a crucial role in projects such as the Belt and Road Initiative, aimed at financing infrastructure development in emerging economies. China's Belt and Road Initiative, which was initially meant to strengthen global partnerships, is facing big problems. China lent a lot of money through this initiative, but it's unlikely that the borrowed money will be paid back. This has led China to become a major debt collector globally, which goes against the original plan of the initiative. Currently, the initiative is not making much progress, and major projects are not being pursued. Within China, state-owned companies, especially after the Evergrande collapse, are having a tough time. Even though Evergrande is not a state-owned company, its collapse has affected other developers. Companies like the China Railway Corporation invested too much in infrastructure, expecting future growth, but now they are burdened with debts that can only be managed if the company grows rapidly. China's state-owned companies collectively owe more than $15.6 trillion, making up around 300% of the country's GDP, which is a significant financial strain. This calculation doesn't even include household debt, which is a crucial part of the problem, as regular households have borrowed a lot, mainly for real estate. Chinese households, inspired by success stories like Shenzhen, have invested in assets that aren't productive and are losing value. If we include household debt, mostly used for unproductive assets, China's overall debt could be as high as 360% of its GDP. Additionally, deflation is making things worse. Deflation is when goods and services become cheaper, and although this might seem good, it's actually a concern. It happens when people spend less due to lower incomes or worries about the future. To stimulate purchases, businesses lower prices, but persistent deflation can slow down economic growth. In China, which relies heavily on low-cost manufacturing, prolonged deflation could lead to bigger problems, risking the country's dominance in this industry to regional rivals. Well, that's it for now. Make sure that you like our video. Please share your views in the comments section with us. Subscribe to the channel to get updated, and do not forget to hit the bell icon to never miss an update. Thanks for watching the video. See you in the next one.